talks at some point after the session ends. We're going to try that.
Again, quick reminder that while we have the different 5 sessions, last time we talked about corporate structures and shareholder agreements. As I said, this was designed to be a full in-person session, so we will complete shareholder agreements today. We're going to go back and finish off some of the pieces we didn't get to last time, and we'll get into financial statements today. Corporate taxation that was kind of on dock for today is probably going to get pushed to June 2nd with shareholder taxation, so we'll kind of do one full tax session. We'll see how far we get through. As I said, we're just going to kind of do about an hour. We'll see where we are. We put a pin in where we are, and we just continue on through the 5 sessions. By the end of the 5 sessions, we will get through all the material. It was designed, as I said, to be about a 5 hours worth of material, just not necessarily in 1 hour chunks. So we're just rolling with it. All right, so quick summary from last week, just to get everybody back into things. And very quickly, also know that some individuals did have some login issues last week. I think Zoom capped us at 300. They tell me that that's been rectified, so we should not have any issues in terms of being capped this time. So anybody who perhaps missed the session last week, I did send out an email where we have a makeup session this coming Monday. So we're going to redo session 1. So anybody online who perhaps missed that one or didn't quite get the memo that you have to be in all 5, all is not lost. You can register for that session, which I'll do, or for session 1, which I'm going to redo again this coming Monday, just to get everybody kind of on board, and then going forward, the final 3 sessions will happen as normal. So if you have any issues with that, just please reach out to myself or to Tanner, and we can certainly send you those invites if you didn't quite get them, but I'm pretty sure everybody did. So if we're talking about last week, we were talking shareholder agreement. I'm not going to go through absolutely everything, but let's talk about why is this important to you. What you're really going to be looking at when you're looking at a shareholder's agreement is the buy-sell aspect of things. So while a shareholders agreement talks about any and all possible eventualities that'll happen within a corporation, a lot of it is just business continuity, could be challenges within the business that perhaps don't have anything to do with you as an advisor. But the specific sections of the shareholder agreement will have to do with buy-sell and certainly with the continuity of the business in the event of the death of a shareholder or perhaps an illness, long-term disability of a shareholder. Those particular pieces are what you want to be looking for as an advisor, because those are your opportunities to offer advice, make sales, of course, and build that credibility with your clients. So when we're looking at the life insurance piece, at the end of the day, we really want to look at certain clauses inside the shareholders agreement. So a little reminder, we want to be looking at ensuring that everybody's required to go through underwriting and try to get an insurance policy. So that could be in the agreement. But the really big pieces that you want to look at is making sure that they are maintaining sufficient death benefit. So if one shareholder is like, well, I don't want to go through underwriting anymore, or I don't want to do this anymore, but the company's like quadrupled in value, the existing policy might not be good enough. So a shareholder agreement should be in place that states, no, you have to participate. You need to make an attempt to get this insurance to protect all parties and all shareholders. But a big one that a lot of clients don't think of, and even advisors sometimes oversee, is distribution of the CDA, that capital dividend account. Now, for those of you who may not be familiar with a capital dividend account, it is a notional credit that allows businesses to pay a tax-free dividend to shareholders. Now, that happens when we pay a death benefit on a policy. So the death benefit minus the ACB, adjusted cost basis, at the time of death creates a CDA credit inside the corporation's accounts and lets them pay a tax-free dividend. That's pretty important, because the question then becomes, who gets that capital dividend payment? Is it the family of the deceased person, or is it the surviving shareholder? Because ultimately, it's the surviving shareholder that declares the capital dividend. They could, if there are no provisions in a shareholder agreement, keep the CDA for themselves. They could turn around and pay out the benefits to the deceased family, but it's a taxable dividend. And they save the CDA for themselves, where they pay themselves future profits tax-free to themselves. So you want to make sure that that's clearly agreed upon of who's getting that CDA in the event that we are triggering that buy sell. So that's a very, very important piece to look at and consider. On the living benefits side, same ideas. We want to make sure that they have to participate and they go through underwriting and, they make those efforts, et cetera, et cetera. But one of the big pieces that a lot of, again, clients don't consider is timing, especially with a disability. Well, how long before we trigger a buy sell? Because I could have a disability that takes me out for 6 months. Well, if the buy sell agreement simply states in the event of disability, I can buy you out at this fixed price. Well, just because I had a disability where I'm out for 3 months doesn't mean I want to get bought out. I'll be back in a few months. But if there's no specification, technically I'm disabled. My partner could buy me out and just kick me right out of the business. So we want to make sure that there's some real clear guidelines. If it's a disability, is it 1 year, 2 years, 3 years before we trigger that particular piece of the shareholders agreement? So you want to make sure that you have, that you have like a really good timelines are built in, but also that you have a sufficient benefit. This is where it gets tricky. Because if it's critical illness, most carriers, 3 million is the maximum they'll give you. Some carriers are talking about going to 4 now, but 3 is kind of that top end of what you can get. So for larger businesses, it could be dicey. Same thing with DI buyout. We could do a disability buyout where there's a lump sum paid to the business to buy out in the event of disability, but most companies cap out at 2 million. Some international carriers will go up to 10, so you'd have to go to specialty insurance. Dealing with international carriers, you might be able to get up to 10, but if you're looking at a Canadian carrier with whom you're licensed to interact with, the maximum that they typically offer is 2 million. So sometimes getting the proper amount of CIDI insurance for those larger corporations that are worth 10, 15, 20 million dollars can be a little bit dicey. Life insurance, not a problem. CIDI can be an issue. So just keep that in the back of your mind that when you are looking at those shareholders agreements, these are some limitations, and certainly some points that you want to share to build that credibility is going to be who's getting the CDA, what are the timelines to trigger a disability buyout. These are things you want to be looking for in the agreement and sharing with your clients. If they're designing their own, those are things you want to share with them so they can have a strong shareholder agreement and builds your credibility. So we also saw a few of these slides last time. I'm going to take just a minute and go through them again because we went through them a little bit quick at the end of the session last time in terms of where do you place the policies? Like where do I want to put this insurance policy when I'm doing a shareholder agreement? In a lot of circumstances, if you have a really simple ownership, you got, let's say, 2 owners who share an operating company, you could do that crisscross method where shareholder A owns a policy on B and shareholder B owns the policy on A. So if either one of them die, they receive money that they can buy the shares out from the other shareholder. It's a pretty simple, straightforward piece. Benefits, it's easy, it's simple. Policies are not in the opco, so you could technically sell the operating company and not impact your policies. The downside is that if shareholder A is half the age of shareholder B, somebody's paying a lot more for premiums than the other. So you got inequity in premiums that need to be paid. That can cause some challenges. So to overcome that, in some cases, the operating company could own the policy. So if the operating company owns the policies on both shareholders, pays the premiums for both of them, and then you've got your net profits that get paid out to shareholder A and B. So that negates the inequity of payments, but it does create the issue that the policy is now in the operating company and subject to creditors. So creditors could seize that as an asset. So not perfect.
We do have a question, Eric.
Yeah, fire away.
Regarding the ACB, does the ACB mean premiums paid for corporate life insurance?
So the adjusted cost basis on a policy is basically premiums paid minus the net cost of pure insurance every year. So net cost of pure insurance is really, think of it as a T1, like a 1-year term annually increasing that just goes up every year exponentially. So the actual ACB is a number that's going to change a little bit every single year. And so it will be your premium paid minus the net cost of pure insurance. That's going to create your ACB. What you can do as an advisor is you can go on at any moment in time once you've sold a policy, go into the carrier's website or the advisor portal. The ACB is something that is always published. So you will always have, this is the ACB at this moment in time. You could also, when doing illustrations at the point of sale, add tax data, and it will tell you this is the ACB at any given year, or at least the expected one. Clients make changes to the policy. The illustration may not be good in the future, but if you just want to know roughly what it is today, it'll be in the illustration, or if it's an in-force, you'll be able to see it at the advisor portal, so you know exactly what the ACB is at this point in time. As I said, there are transactions that can impact that. If client borrows money and pays it back, you know, they can do it, or even if they do a partial surrender of a par policy, that will impact the ACB in the future as well. So there's lots of things that can play into it. But the simple answer, it'll always be premium paid minus NCPI gives you that ACB at the end. All right. Hopefully that answers the question. The other scenarios that you'll sometimes come across is you might have the two shareholders might have their own holding companies. So sometimes they'll have their own holding companies. So this gives them that extra layer of protection. As you may recall, we talked about that last week. You have your operating company, you move all the profits to holding company, and the holding company keeps all the profits in there. So it gives you a little layer of protection from creditors and all that jazz. But sometimes you have two shareholders, they might have their own personal holding companies. So you could technically put the policies in Holdco A and Holdco B, and then have dividends pay up, tax-free dividends, because they are related companies, can be paid up to pay for the policies. So that is certainly the structure that we can sometimes see. The issue, again, that you might have over here is that, again, Holdco A has the policy on shareholder B and vice versa. So sometimes if OpCo is sold, you're now left with holding companies that have, again, someone else's policies. So occasionally that can be a little bit of a challenge here to watch out for if you're trying to give each other their policies afterwards. So you gotta be careful on that. The cleanest one, and this is what I usually recommend, is either going to look like this structure here where you've got shareholder AB with their holding companies. We would advise that they set up a joint holding companies purely to hold the insurance policies. That's it. That's all. OpCo pays up all of its profits to Holdco AB. Holdco AB pays the premiums on both policies, and then the net profit from there goes up to Holdco A, Holdco B 50-50, and then the shareholders have their money, and away you go. If you want to simplify this down even more, you just remove those two holding companies, and you simply have the shareholders who jointly own 50-50 a single holding company. And again, all the profits are held there. It just simplifies things a little bit. There could be reasons to have personal holding companies, because sometimes shareholder A might have other business interests outside where they're not involved with shareholder B. So yeah, so they would have a personal holding company that would own shares of those companies. So, but if this is just two individuals or three individuals together with no other business interests, one holding company, they all jointly own it, keeps it nice and clean. So that's usually where you'd kind of want to put it. In all times, holding company is the best place to put the policy, because you can sell your operating company without worrying about the policies that are inside that OpCo. If clients don't have a holding company, I always suggest that they open one up, put the policies in that holding company, move up their profits from OpCo. So at some point in the future, if they want to divest themselves of OpCo, sell it off, or even the kids want to take over and do something else with it, no problem. Your client's assets are in the holding company, the policies in the holding company. You can get rid of OpCo or do anything you want with it, and you're not impacting your assets and or your policy. That's typically the best way to do that. All right. So let's go through
one additional question, Eric.
Yeah.
Will there be a cheat sheet of clauses for us to reference?
I don't have a cheat sheet per se. At the end of the day, what I can suggest is, and I will, my last slide today, I will have a QR code, and I had it up on the last time as well, that took you to the large case website for Industrial Alliance, where we do have an article on shareholder agreements. there's some information in there that can potentially help you. Otherwise, a good Google search of, what are the most important things in a shareholder agreement? You might be able to find some of the cheat sheets out there. I don't have one specifically to share, unfortunately. But at the end of the day, the big ones to remember is when you're looking at buy sell, is what triggers a life insurance, what happens in the event of death. So treat the life insurance, and what happens in the event of disability or critical illness that would trigger those policies being paid out. Those are the big ones you as an advisor want to look at, along with CDA. So it's really just 4 or 5 main pieces that you want to look at. So it's not a huge list, but those would be the pieces that I'd focus on there. But again, as I said, go to our large case website. There is a QR code. It'll be on the last slide today. Go into the documents, and we have some articles on shareholder agreements that'll have most of that info, which I think would be helpful. So in a shareholders agreement, how do we fund it? So the big question that we get here is going, that's great. You talked about shareholders agreements. There's some good information here. And as I said, it's the most harmless way for you to open the discussion up with some of your potential clients or potential business owners. If you want to kind of open up that discussion with something that's not product related or not service related, and just kind of gives you the opportunity to show some credibility, show that you can help them. That's a great way to go, but that's nice. But how do we monetize that? At the end of the day, you're all salespeople. We got to sell insurance products in order to make some or bring assets under management too, to make money. So let's look at, how do we pay for a life insurance policy or the client? Where's the opportunity here? Well, for you guys, the opportunity is funding a buy-sell agreement using life insurance CI/DI. I'm going to focus on life insurance today. CI and DI, I'll kind of park that to the side. They're a little bit harder to do and more rare. So I'm kind of, in the interest of time, I'm going to focus just on life insurance today and take you through an example of term versus participating, term versus perm. So at the end of the day, term insurance can meet the needs of a client. It's not always, you don't always have to do permanent participating insurance, even though that's my favorite type of insurance. I will always lean that way. But the reality is, for some clients who perhaps are early in the business process, don't have huge cash flows, start with term. Don't even go permanent with them. They can't afford the premium. You're wasting everyone's time. So things like term insurance can give you that affordability. It could be nice and simple. And sometimes you have clients who are going, hey, we're going in business. We got a 10, 15-year horizon and we're out. All right. Well, maybe a 15-year term or 20-year term is all you really need. If the client's a little younger, maybe we do a 30-year term. So we do have that flexibility in term insurance now, where you can go much longer terms and fix in those costs. So there's really great opportunity for term to kick things off, and depending on the needs, because whether it be term or permanent, CDA still kicks in. They die, it's still a death benefit. They still get CDA. All the good stuff's there. What you need to be careful about is if the clients eventually decide to stay in business longer than predicted, now you're dealing with renewals and or a policy that expires at some point in time. So that's where things like permanent participating insurance, maybe a UL or T/100, might prove to be a little bit more interesting. So every situation is different. So let's go through a scenario here where we're going to look at kind of 3 options. We're going to look at a male who's 40, non-smoker. And this male's kind of going, hey, I'm in business. I got a partner. Let's just say there's 2 40-year-old males together. We're going to look at it from the point of view of just one business owner to keep it simple today. So let's just say the first business owner is 40 years old. And they're going, we think by age 70, we're probably going to call it a day. So there's a couple of options here. You could turn around and say, hey, we're going to do some term insurance. And let's say the client's business is worth $2 million, let's just say. So $1 million per business owner. So if we were to do $1 million of term insurance, we can look at maybe doing a T30, or in this example here, it looked a little bit more advantageous to do a T20 and then buy a new T10 20 years from now. This assumes 2 things. A, the rates don't change. So this is current rates based on today. And B, that the client will remain insured. So there's a risk to doing it, but it does prove to be a little bit less expensive than, or more advantageous for a client from a cash flow point of view than doing a full-on T30 today. So we're kind of doing a bit of a blend of T20 and T10. We're also going to look at a T100, just straight up term to 100, no cash value, no bills, no whistles. We're looking at about $8,600 a premium. And then we're going to look at a combination of par insurance and T10. So we're looking at about $1 million, where half of it is par insurance, half of it is T10, and we're looking at about $19,000 of premiums on this particular policy. So cumulative, if we look at 30 years, you can see that, yeah, the par policy is $570,000. It is quite a bit more expensive than term. That would only cost $65,000. So clients are going to look at that going, what am I getting for it? So let's take a look at what it looks like from an evolution of the death benefit and total death benefit. So on this particular example here, we can see that there's a straight line kind of from left to right. That is your T100. It's $1 million. It doesn't change. That dark blue line at age 70 kind of drops to 0. That's your term policy. T20 plus a T10. If it drops off, there's no death benefit left. Then you have your par insurance is kind of the squiggly lighter blue line. Because we had a T10 policy, the par policy increases with time. The idea is that after 10 years, that policy has now grown to be almost $1 million. You drop the term, and now you've got $1 million policy that grows with time. So yeah, the death benefit does eventually exceed $1 million. If the clients have a fixed business valuation where they don't think it's going to grow, the T100, maybe that term 20 and 10 works. But if you got a business that you think is going to grow and the value is going to grow with time, you can see where the par comes into play, because the death benefit increases with time to offset some of those future growths. As the business valuation grows, having a growing death benefit has quite a bit of value and quite a bit of merit as well. In addition to it, we do have to take cash value into account, and the second half of today's presentation is going to be on accounting. So you'll see where this comes back into play on the client's books. But we certainly want to look at what are some of the cash values that are here. So you can see in year 5 at age 70 and age 85, there's some cash value that the par would bring in. The term and T100 do not have. So graphically, it looks like this. So if you look at the cumulative premiums, you can see the lower line is the T20 and T10. That lighter blue line down the middle there is the T100. And then I guess that second highest line, I guess it looks green, a bit colorblind, so maybe it's a lighter green, or maybe it's orange, whatever. That is the cumulative premiums of the par policy, and then the top line is the total cash value. So when you're showing the client going, yeah, you're paying more for par insurance, but look at what you're getting with it. So there's where you started getting into those discussions of, does par make sense versus term or T100? You can start to see where it does pay out. You pay more premium, but you got more death benefit, and you do get that additional cash value that has to be considered. So there's value to it. The age-old, well, what if I bought term and invested the difference? We see that a lot. Clients ask that a lot. They're going, why would I pay extra premium? I'm just going to invest that money. I can do better. Some cases, yeah, they could. It's possible. It absolutely is. I'm going to show an example here where the clients are buying the term or buying the T100 and investing the difference instead of doing par insurance. And we're going to use kind of an IA diversified portfolio. The portfolio itself obviously has changing rates of return, but it is a balanced portfolio. So we're going to go with that one and say, well, what would happen had the clients put it in? And if we kind of use some of the historical rates of return from a diverse portfolio, what would it look like? So in this example, the clients would for 20 years be paying $1,000 for their term. So they would be putting $18,000 into the investments. And for the last 10 years, it'd be $14,470. And if it's a T100, the base premium was $8,600. So they'd be putting in $10,000 for the total of 30 years. So it's basically the premium plus the difference of what they would have been paying with par. Remember, par was about $19,000 a year. So there's your difference. So if you do the math, you can kind of see where these numbers come from. So what does that look like? Well, what that basically means is if we look at, let's say, age 70, if you had a T100, the T100 is that lower, lighter blue line, you'd have just shy of $500,000 in a balance fund net of tax in your corporate account. If you did the T20 and the T10, you'd have just shy of 800,000 at age 70 net of tax in the corporate account. Looks pretty good, but we can see here that the par still wins. There's $1.2 million of par, of cash value inside the par policy. Now you might be asking yourself going, wow, how is that possible? Keep in mind that this is a non-registered investment that is subject to tax every single year inside the corporation. And while we haven't done corporate tax rates yet, and that's probably on docket for next week's session, or 2 weeks from now, should I say, we'll go over corporate taxation. Passive income in a corporation is taxed at 50.17%, at least in Ontario. So across the country, it's usually around 50.1, 50.2, depending on the province, but they're all over 50%. So as a result, half of your growth every single year is loss of taxation inside a corp. So as a result, investing the difference inside a corporation is not as sexy as it sounds. Having the tax shelter of that par policy makes a pretty big difference. So that's why you're seeing these numbers and it doesn't look as sexy as you might think it is. So it's A, there's the tax grind. B, I'm also using a balance fund. If your clients go equity and they're doing 10, 12, 13, 14% year over year, yeah, those numbers look a heck of a lot better. So I'm not saying that you can't do better than par, but let's compare apples to apples. Par Insurance is a kind of a balanced portfolio in of itself. So let's compare apples to apples here and be fair. In a similar type of investment, we can see that the tax shelter does pay out.
We have a question as well, Eric.
Yeah. Fire away.
What are your underlying assumptions about the outside investments, example rate of return?
So we are using the IA diversified portfolio. So I believe the total rate was somewhere around 5 or 6% is what they were anticipating. It is blended of, obviously it's a balance. So there's some equity, there's some capital gains, there's some dividends, there's some fixed income in there. But it is in that 5 to 6% range is what, when they built this case, is what they had plugged in based on the rate of return of our diversified portfolio. So it is a blended rate. We are using the different tax pieces. So if it's capital gains, only half is taxable. If it's dividend, you get the dividend tax credit, et cetera, et cetera. Those have all been applied into these into those numbers. So if we look at the net estate value of the underlying policy plus the investments, we can see here that once again, Par Insurance is mostly better, but there is a point in time where in those earlier years that, yeah, the term policy or the T100 with its death benefit plus the investment component would look a little bit better than Par Insurance. It absolutely would. We are looking kind of those first 20 or so years before Par kind of really comes ahead of everybody else. So yeah, there is merit in the argument of, hey, let's buy term, invest the difference for the early years. If your clients live beyond age 60, or if this client lives beyond age 60, you can see where suddenly if they were to die beyond there, suddenly that death benefit going through the CDA and paying out to the estate is superior to any of the other options. And that's all because of that CDA credit. You got tax-free death benefit going into the corp, paid out to the CDA. It's a lot more efficient than the investment portfolio that would now have to be paid out as a dividend and is subject to taxation when you go to pull that money out. So you can certainly see how net estate, there's value there as well on the Par side of things. So in this particular example here, we're saying, well, what if we turn around and just did $1 million of Par instead of half and half? What would that look like? So now we're looking at, let's say, $50,000 of premium, and we're going to offset it after 10 years. So if you got a client who, let's say, have a lot of cash in their company, a lot of retained earnings, lots of cash, maybe this is a potential option. If we were to throw in that Par policy, what would it look like? Well, needless to say, you're paying a lot more premium, you're getting more bang for buck. So we can see that right off the bat, net estate value all the way through, that would pay out much higher than even in term and invest the difference. Based on our previous example, you are looking at a par policy, at $50,000 a year, does give the clients a lot more value. But as I said, they have to be able to afford it. Not everybody can, but if they can, you can see here, there's definitely tremendous value there.
We have some follow-up questions.
Yeah, fire away.
From the last question, the same rate assumptions are used in both inside and outside investments?
I'm not sure what you're referring to by inside and outside investments. The investments here are being done inside the corporation, and all my examples here are being done inside the corp. So if you mean inside the corp versus outside, i.e. personal, that's what you mean. I'm not doing any personal investments here. Everything's being invested inside the corporation. So hopefully that answers the question.
We have two more. What if you invest the difference into a TFSA?
Corporations cannot invest in a TFSA, unfortunately. So the only way to do that would be to pay yourself a dividend out of the corp, pay the dividend taxes, and then invest the net amount. As a result of the tax grind of taking money out of the corp, you would find yourself in a lot of situations to be quite a bit worse off, in the sense that you have less money to invest net of tax. The argument can be made that, hey, with a TFSA, you make it up by not paying tax in the future. So a couple things to consider there. It's not absolutely foolproof, but when you start doing the math of tax grind from corp to personal, then into TFSA, it takes a while for TFSA to beat out the corp. That's factor number one. Factor number two, TFSAs are limited to $7,000 a year. If you've got a client who's got 30, 40, 50,000 left over in the end, TFSA is not going to do you any good. Especially in this example here, we were looking at investing, anywhere from 10 to 20,000, or just shy of 20,000. I think 18 was the max. We don't have $18,000 a year to put in TFSA. So you may run into that issue where the client just don't have the room to do it. But if they do the math, it is possible. If you want to analyze it, go for it. Sometimes it may be better, but in a lot of cases, you may find that you're not in a position where it makes a whole lot of sense, especially in those earlier years, and it takes a long time for it to catch up. So not perfect, but in my example here, I'm just doing purely inside the corp. I'm just keeping it simple for today, but yeah, there's other ways that you can do that.
And then what are the net shareholder values on withdrawal at age 70?
So net estate value, we are basically looking at them here. So at age 70, I can maybe go back one or two slides. We had them basically here. So if the clients, was this it? Yeah, so net estate value on death. So if they died at age 70, you would be looking at $3 million of par. T100 is 1.3 million. In turn, would be paying you about $800,000. So that would be the net if you died at age 70. If it was, what's the cash, the net cash values at age 70, we can see here on this particular slide, you're looking at 800, term would be 800,000 before you pull it out. So you'd have to pay dividends on that. T100 is just shy of 500, and you got 1.2 million on the par piece. So again, this particular slide is pre-personal tax by paying yourself a dividend. But if you're looking on death, these amounts over here were net. So you can see that again, par certainly would be the better choice or better option at age 70 in the event of death. So those are the numbers that I have for you.
Yeah, they asked if still alive.
Yeah, so still alive. These were the numbers pre-tax, so you'd have to take the dividend tax out of that piece. So at the end of the day, again, those are the numbers. Whatever the net numbers are, it'll just be less than what you see on the screen. But in terms of the ratio of who's paying out, they would remain the same from a ratio point of view.
And then lastly, just confirmation on the first question. It's inside the insurance policy versus outside insurance policy for the assumptions.
Yeah, so from an assumption point of view, the investment component is taxable because it is non-registered inside a corporation, and obviously an insurance policy is tax sheltered, so it is not, the growth of cash surrender value is not subject to taxation inside an insurance policy, regardless of who owns the policy. All right, last little piece here, and we'll move on to getting some of the accounting stuff. So the last piece to look at is if clients are looking at that par insurance or even investing, well, what happens if at age 70 they want to start creating an income stream? So this is how you as an advisor can not only talk about, hey, here's how we're going to, or here are your options of how we can fund your buy-sell agreement. But if you were to do term and invest the difference, or if you were to do par insurance and have that cash value in there, how do you tap into that income? What impact does it have at age 70? You know, how can we create income for you? Well, with a par policy, we can do back-end leveraging. We call that an insured retirement strategy, where you are effectively using the cash value of your insurance policy to guarantee a loan. That loan creates an income stream for the individual. So the corporation would borrow some money, would then pay a dividend to the individual. The individual pays some taxes on dividend, and they would have a net income in their pocket. On death, the insurance policy pays off a loan, the balance goes into the corp, and then comes out the CDA on the back end. So here we have a quick little example that shows if you were to do term and invest the difference, what would the income stream look like? So we can see that if we had an income stream, it's a bit of a decreasing income stream on this one. Would have preferred if the person who wrote the case had done it even, but they didn't. But it gives an idea here at age 70, the clients could be pulling out $56,000 after tax would be in their pocket, and that would decrease pretty rapidly to about $32,000 for the next 10 years. And then in their 80s and 90s, we're getting into around 30, 29,000, etc. If we were to put money into the par insurance, the net payable to the shareholder after dividend taxes would be about $30,500 if they did the $500,000 with $19,000 premium for 30 years, or if they did that $50,000 for 10 years, they'd have about $38,000. So obviously, if the clients funded their policy a little bit faster in the early years, it grows faster, gives you a little bit more income. So when all is said and done, from let's say age 70 to age 90, the net income in their pocket is pretty similar. The term and invest the difference would probably give you a little bit more net income in your pocket. I'm not going to argue on that one. They probably have a little bit more money in their pocket when everything's said and done. But what you need to remember is that if you did term and invest the difference at age 70, the term's gone. So when you look at net estate value, if they were to say die at age 80, they would only have about $250,000 at age 80 based on that dark line, because that's all that would be left in their investments. Whereas the par policies, they would have created an income stream, but you still have some leftover death benefit. So you can certainly see at age 80, they certainly win, and then we kind of cap it off at age 90. At age 90, there'd be no investments left. And if they were to die, you could have anywhere from $1.2 to $1.5 million being paid out to the estate. So while they might give up $100,000, maybe $200,000 of income at retirement, they are still walking away with an extra 1.2 to 1.5 million to the estate. So it is an insurance solution after all. So that gives you a bit of an idea of things you can look at, how you can position some of these conversations with your clients to help them understand the value of term versus perm versus invest the difference, all the while talking about their buy-sell agreements, shareholder agreements, and then how do we fund this? And it just leads into the, well, what about income at retirement conversation? So you can see how this conversation can evolve with a client and how you can just kind of slowly build on ideas and build on concepts to that conversation over time. So hopefully that shares a little bit of value for you. I had a few little quiz questions here. I'm going to skip those in the interest of time. We had some good questions earlier, so now I'm just going to move things along so that we can respect everyone's time. We got about 20 minutes left to go over the accounting section. So we're going to get into accounting and taxation. What I'm going to review with you today is really financial statements. We're going to talk about the different types of financial statements, what you want to look for as an advisor, and kind of why it's important. Like I said, it'll take us right up to the top of the hour, and then we'll wrap it up at that piece. And then
Eric,
2 weeks from now, yeah, go ahead.
just before you move along, we did have a few questions about the last topic.
Okay, fire away. We'll try to do those quickly, so I need to get through this as well.
How does the interest on the loan work into this?
So interest on the loan, there's two things that you can do. The corporation can pay the interest itself, or you can capitalize the interest, which is what a lot of them end up doing, where you turn around and just say, hey, when interest is charged, we're just going to increase the line of credit every year versus paying it back. Those are the two options that you do have available to you. Most of the time they capitalize it so the clients aren't actually physically dispersing interest costs to, in their equation.
What is the impact of the small business tax deduction for the term and investment, the different strategy in an OPCO?
Excellent question. What ends up happening when you are doing term and invest the difference, you are creating passive income. That passive income, along with any other investments that or passive income that the operating company has, will be combined. And if you reach a point where you are making more than $50,000 a year of passive income, so that can be capital gains, dividends, interest, royalties are included in there. If you put all those together, if you are making more than $50,000 a year of passive income, it will start to reduce your small business deduction. So that can have an impact when you are doing term and invest the difference. If the clients do not have any other, and they've got, $1 million or $2 million of investments, it's not going to trigger $50,000. It's not likely to trigger the $50,000 every year. You're probably going to be okay. But when you start getting into clients who now have $2, $3, $4 million and they're making 5-6% on it, yeah, now you're in a position where that passive income will impact your small business deduction.
Does the net to shareholders using buy term investment the rest factor in the huge taxes they would have paid on the passive income during the years of growth?
Say that again. I'm maybe going to try to read it. I can't see it on the screen. Just read that again. I'm not sure I followed.
Does the net to shareholders using buy term investment invest the rest factor in the huge taxes they would have paid on the passive income during the years of growth?
Yes. When you look at the slides that I was showing you over here, net estate values, these all take into account taxation they would pay on an annual basis. We are clawing away the taxes on an annual basis in our examples.
And then I'll combine these two together. Universal YRT not used in the illustration. Why not? And is the line of credit based on net surrender value?
So line of credit is based on 90% of the surrender value of the policy. In our example, it's typically what we'll show at. And in terms of why we didn't use a UL YRT, just simply keeping it simple. It is an option you can look at. I'm just trying to show 3 different options here and just simplify the life for everybody. Not everybody fully understands how that works. So in the interest of time, we just kept it simple with the T to 100. But it is an option. There's more than those 3 options. We're just keeping everything simple for you. Okay, I'm going to close questions there because we do have to make sure we get through this. I don't have 15 minutes, so I'm going to try and get through this particular section. So let's talk about financial statements. At the end of the day, you as advisors need to understand a little bit of what you're looking at when you look at financial statements, because it does provide you with a strong overview of how a company is doing. You don't need to be an accounting professional. You don't need to sit there and look at every single statement that they have and everything that's in there. Don't need to be an expert, but you do need to have an idea of what to look for. And if the clients do give you some of their financials, where do you want to hone in? What are the pieces that are important to you? And that's what I want to walk you through today. So the big thing to remember with financial statements is they are a set of documents that will tell you the health of a company at a certain point in time. So always look at the date. It's the big thing. Client might give you, oh, well, here's a balance sheet. And the balance sheet's like 4 years old. It's not going to do you any good. This was 4 years ago. I need the most recent one. It could be a year old. It could be 6 months old. That's okay. Because in some cases, businesses don't go January 1st to December 31st. Some of their tax years could be different. A business can decide what its fiscal year will be. They could go July 1st to June 30th. So you might have, here's the balance sheet of June 30th, 2025. That would be 11 months old, but it might be the last balance sheet that their accountant actually produced. So you run with it. that's okay. So just keep that in mind, that sometimes some of them could be a little older, but anything that's more than a year, year and a half old, I'd be careful with that. We're going to talk about today, we're going to look at balance sheets, statement of retained earnings. We'll talk really quickly about cash flow statements and income statements, because there's some information on all of these that can be important to you. In particular, the balance sheet's probably the most important one that you're going to be looking at, in my opinion. The balance sheet is what's going to show you all of the assets. It will show you all the liabilities, and the difference between the two will be your shareholders' equity. That's type of information that you want to know. You want to know, what are those assets? Where are those assets? Are there liabilities? What are those liabilities? And then finally, like, what's the retained earnings? What's left in that shareholders' equity? There's all important information there and opportunities for you as an advisor to ensure it, to make some sales. And those opportunities will be there. And this is where you want to look at. Quick note very quickly on book value versus fair market value. Again, don't need to be an expert, but when you're looking at the valuation of an asset or even a liability, well, what's the accountant using? Are they using book value? In many cases, the book value is what they paid for something. So say, oh, we own a building. The building's worth $1 million. Well, we bought the building for $1 million 15 years ago. Well, fair market value of that building could be $3 million today. It could be worth a lot more, but depending on how they want to keep the books, they may not always be using fair market value. What's the asset worth today versus what did we pay for it? So do have a look at that. Try to understand those pieces, because that could make a huge difference if you're looking at potential future tax liabilities. What did you pay for building? What is it worth? Well, there's a growth there. There's a tax liability. We may need to insure that in the event of death. The opportunity there. So really, when you're going to be looking at a balance sheet, you're really going to be looking a lot at the assets. So it gives you an idea of what's the health of the corporation. And on the asset side of things, we really want to look at how much cash is in the company. What other assets have? Are there investable assets? If they do have insurance policies with cash surrender value, they could and should appear in the asset piece. So you can let clients know, you want to buy that par policy? That's okay. You're spending a lot of premium. Don't worry about it. That cash surrender value goes into your books. It will help the overall health of your company. It is an asset you can show in your books. Really should be showing that. So that's something you look at in assets. But you as an advisor in particular, you want to look at, what are those investable assets? Are they creating a passive income challenge for the client that could be reducing that small business deduction? Opportunity there to tax shelter it with permanent insurance, whether it be UL or PAR. And even cash. Are they sitting on a boat ton of cash? Do they need that much cash? What are they doing with it? Again, that could help you with funding some of those policies. So you want to look at those assets and just get an idea of what's there and like what can we move and tax shelter and help the clients save taxes and be a little more efficient. The other thing that you're going to want to look at is notes. Are there any notes to the balance sheet? And this is where you can kind of see if there are investments. Usually here you'll see where are they invested, what's the book value, maybe the fair market value of these investments. It gives you a rough idea of, again, where are they? Is there going to be an issue with small business deduction? And if I'm going to be talking about tax efficiencies, is there certain investments I want to target when having that conversation with a client? On the liability side, here's where you want to have a look and say, are there major loans? Are there mortgages on some of these properties? Is there an opportunity for term insurance in the event of death to pay off those liabilities and help the corporation be a little bit healthier, especially if it's a family business that's probably going to stay in the family? You may want to look at some term insurance to offset some of these loans. So if the primary business owner does pass away, we can wipe out those loans and have a very healthy company and a healthy balance sheet for the next generation who may not know how to run the business at first, might need a little extra help. And if they've got some liabilities, well, I can tell you right now that some bankers may be liable to call those loans if the primary business owner passes away and the new people coming into the business don't know what's going on. bankers tend to be inclined to protect themselves, and they may say, we're calling those loans. You got to pay those loans. You got 90 days to pay them. And the banks can often do that depending on the covenants of the loan. So you got to be careful there. So maybe there's an opportunity to insure some of those liabilities. So have a look, see what's there. There's another great opportunity for you to potentially insure those, cover those debts, or just general receivables, and just make sure that they've got some protection there. On the shareholder equity side of things, what we're really looking here most of the time is the share capital. We talked a little bit about what is share capital when we did business structures last time. For those who may have missed the first one, we'll come back to that on Monday for the makeup session. But at the end of the day, what we're really looking for here is the retained earnings. I want to understand, like, okay, what are the retained earnings in the company? What's it worth? How much money are you leaving in the corporation at the end of the day? So when you're looking at an income statement, you got net income at the end of the year. That net income goes into retained earnings. You pay dividends from retained earnings. That will reduce retained earnings when you pay dividends to take money out of the corp. Do be aware the retained earnings does not equal cash. Retained earnings simply said this is the net income value of what we have left in the corporation. It could be made up of cash, other investable assets, cash surrender value in an insurance policy, and just other assets on the balance sheet. That is what retained earnings could potentially be. So just because you see an example here, $443,000 of retained earnings doesn't mean that there's $400,000 of cash sitting in the corporation. There's other assets. The money could be reinvested in the corp in other ways. So just keep that in mind. So when you are looking at retained earnings, you kind of want to look at year-on-year balance. If you can see the last couple of years, ideally that number should be increasing. So you are looking for a number that is going to increase. But as I said, even if it decreases a little bit, it could be that the clients just decided to pay themselves a bigger dividend this year and said, you know what, we've had 3-4 really good years in a row. I'm paying myself a larger dividend this year. I'm taking some money out for myself so I can go have fun or renovate my house or do other stuff with it. That's okay. Same thing, you're going to want to look at notes to the financial statements on there as well. There might be some notes, especially here you'll see point number 4 that will talk about the different share capital. You'll see the different types of classes of shares, maybe what they're worth. Again, we talked about that briefly last time, but this is where you can kind of get some of that information and go, okay, who owns this company? What types of shares are there and whatnot? There's some important information there that you can look at, especially if there are other shareholders. You want to know who they are because those are potential clients too. Get some referrals. That's how you monetize that information. But in particular, if we want to look at how do bankers use this balance sheet, this is going to be important if you're going to be doing leveraging. So if you're going to be doing immediate financing arrangements or insured retirement strategy where you're borrowing against an insurance policy, whether it be UL or PAR insurance, banks are going to look at the balance sheet to see what's the state of the corporation. How healthy is this? They're going to do all sorts of ratios. They're going to do calculations and ratios to see, okay, how are they doing? Don't need to be an expert, but they're certainly going to look at things like the current ratio, what's current assets versus current liabilities. They want to know, is the company healthy? Are they running out of money? Is there a risk? They're going to look at these pieces. They want to make sure that there's more assets and liabilities. And if it's the other way around, well, why? And what's the risk here? So bankers are going to look at that. Even if you have an insurance policy to guarantee the loan, the health of the corporation is still a factor. It can still impact the rate at which you can borrow money, even with the guarantee of an insurance policy. Because ultimately, a bank does not want to call a loan. They don't want to get the insurance company to have to cash out the insurance policy to pay the loan. It's not ideal for the bankers. They'd rather the corporation be healthy and can sustain that policy on its own. It's always the ideal piece. So with that, they're going to look at income statements, profits, losses, cash flow. So an income statement really shows you, again, all those cash flows kind of coming in and whether or not the company has been profitable at the end of the day. It's all the money that came in minus all the money that went out, cost of goods sold, expenses, salary, everything. You'll find all of that on an income statement. Again, don't need to be an expert on that one. You simply want to see a positive number every year, and hopefully a growing positive number is kind of what you're looking for. In some cases, you might be looking at things like book income versus taxable income. This is going to be important, especially when you get asked about insurance premiums. Because at the end of the day, an insurance premium, it's very rare that you can deduct it from taxes, but it is an expense. So there's book income, which is going, hey, these are our profits. We've paid all of our different things, but there's also taxable income where they say, hey, some expenses we can use to deduct taxable income, some we cannot. So there's that reconciliation method. So do keep that in mind that unfortunately, insurance premiums typically are not something that we can deduct for taxable income. It is an expense. It's got to show up in the books. The premium has to come out of the corporation, but it's very rare that it's a taxable expense. There's an exception, and I'll come to it in a couple of slides. I'm going to skip depreciation for now, just in the interest of time. So let's come into, again, insurance expenses for those premiums. So at the end of the day, life insurance is not typically a tax deductible expense. The one exception, I'm just going to get to that slide over here. So I'm skipping a few slides, just in the interest of time. The one exception is if the corporation is trying to get a loan and the bank is insisting that the shareholders take out a life insurance policy as part of the loan agreement. So it's the bank that has to insist that you have the policy to have a loan. They have to have it in writing. It has to be a condition of the loan, and all of that is part of that loan agreement. And then and only then can you deduct the net cost of pure insurance for the policy, not the actual premium. And it's even proportional. So let's say that your business owners decide to buy $1 million policy and they want to do, I'm going to buy the $1 million permanent policy. I've got a $250,000 loan. They want to make me buy a policy. Fine. I'm going to buy this $1 million par policy. I'm going to have this huge premium. I'm going to write the whole premium off. It's going to be great. That doesn't work, unfortunately. You can only write off the net cost of pure insurance, not the actual premium. And you can only write off the ratio of loan versus life insurance. So in that $1 million policy, you can only write off 25% of the net cost of pure insurance. So it's really fractional. It's not a huge deduction. When a client tells me, can I do it? I go, yeah, in certain exceptional circumstances, but the tax write-off is not what you think it's going to be. It's a fraction of what it is. In some cases, it's a couple $1,000. And if the company's making $1 million a year, $1,000 deduction means nothing to them. So it's not something that I wouldn't hang your hat on this strategy to try and sell an insurance policy. So if we look at cash flow statements, same idea. Cash flow just shows all of the money coming in and out. You don't really need to worry about this piece. I'm kind of going to skip this right now because I know we're kind of at the top of the hour. I just want to take this last slide here, take a minute over here, then I'll let you guys go. Why is this important? Well, for you as an advisor, if you are writing larger policies, financial underwriting comes into play. Insurance companies are going to want to see these statements. They are going to want you to prove that the clients, A, can afford the premium, B, that the amount you're asking for is justifiable. So they're going to look at those statements to go, where's that money coming from? And should we be insuring them for this amount? It can also come into product selection, term versus perm, strength of the balance sheet. Par policies do add assets to the balance sheet that are important. And things like CDA and RDTOH credits, which we will talk about next time as well. We'll get into a little more details, especially if you're doing retirement planning. Are there tax credits so we can take advantage of to pull money out of that corporation and create an income flow for clients? So these are all important pieces that are, need to be part of the discussion, and you as an advisor need to be ready, because if you put an application in, it's not just health anymore, especially if you're doing a big policy with huge premiums and larger death benefits. financial underwriting will come into play. You've got to justify the financials, so you're going to need to look at those statements and understand where is this money coming from. All right, we'll skip those little questions here. So as promised, for those of you who want to access our large case website, there's a QR code and the website's there. I'll leave this on for another minute or so. Once again, thank you so much for joining us. Again, if you missed the first session, please make sure to register for the makeup class. It'll be on Monday, the 25th. Our next session is 2 Tuesdays from now. I'm going to be in Halifax at a management meeting most of next week. So I'm around on Monday, but then Tuesday to Friday I'm away. So we're going to skip a week. Then on, I think it's June 2nd, if memory serves, we'll kick things off again at 11 a.m. for the third session. And on that one, we'll get into real taxation, corporate taxation, personal taxation, how those kind of integrate and blend together, and how to have those conversations with your clients, especially when you are doing some planning. And then that'll lead into trusts and some great concepts over the next couple of sessions there. So hopefully everybody got some good stuff out of that. Again, once again, we're in about a minute or two long. Lots of things to say and lots of great questions today. Keep those questions coming. Really appreciate that. And I think going forward, we'll, I said, we're on schedule and we should be doing great. Tanner, any questions in the chat that I can address right now for those who might still be online?
Yeah, there was quite a few that came in.
Okay.
So
I'll address those now. So anybody who logged off, they might see it in the recording afterwards. So for those of you who have to go, please go. For those who want to sit and listen to the answers, I'll take a few more minutes and handle those questions for those who want to stay on a few more minutes.